WiseTech, listed in Australia, is a software provider for the global logistics industry. It's part of a select band of software as a service, or SaaS stocks, that are highly rated because they're perceived to be fast growing and have the potential to scale globally. The key with these companies is that the marginal cost per user is almost zero. This enables them to deliver great operating leverage, and the resulting cash flow provides great returns for shareholders. Since IPO, WiseTech's revenue is up over 4 times, and by September the stock had risen even more, up 9.5 times. J Capital then released a report suggesting that all was not well, and that they thought WiseTech might actually be a fraud. Since then, the stock has dropped, and we thought it was time to take a look. We believe that WiseTech has nothing in common with the successful SaaS stocks other than its extremely high valuation. At best, investors are being misguided, and we think there's a possibility it may even be worse. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. We think WiseTech is inflating their organic growth by buying customers. We think they're using contorted accounting to give the impression of profit and cash flow where there really isn't any, and then covering it up by issuing equity to put some cash on the balance sheet. But bear in mind, most of the cash on the balance sheet is set to disappear during 2020 as they pay off their deferred liabilities. Ultimately, we think WiseTech would be insolvent if it didn't have access to the equity market, and we expect they will be back in the market in 2020 issuing equity. We're going to use our standard governance, accounting and peer performance approach to isolate the particular issues. The first thing that stands out is that the founder, Mr. White, remains firmly in control. He owns 44% of the company, and together with his long-term associates and friends on the board, they have a majority. This may explain why Mr. White is able to supplement his salary with various related party rental deals. It's not illegal, but it raises concerns that Mr. White is putting himself and his family ahead of the firm and the minorities. The next problem is their use of a deed of cross guarantee. This is an Australian device that allows companies to shelter their subsidiaries from the audit. We assume the guarantee regulation was originally set up by the government to protect creditors while cutting costs and hassle for private companies. Fair enough, but there really isn't any valid reason to be used in a listed company other than sheltering management from audit scrutiny, and we think it weakens what is already a fairly poor protection for minority shareholders, most of whom would think it was worth spending a few extra dollars to check for fraud and to monitor the management accounts. The cross-guarantee means that over 100% of WiseTech's profits and 86% of their assets don't get audited at all. In other words, nearly all of the numbers that investors rely on could simply have been made up. But as long as WiseTech can issue equity to pay its bills, we won't find out the truth. For the record, the auditors were paid $1.3 million last year, 2% of profits, but essentially 0% of market cap, and so even if fees doubled, it wouldn't be unreasonable. Even with their minimal audit, the accounting raises concerns. WiseTech is a deal machine, and since FY15 it's spent nearly 400 million Aussie dollars buying companies, most of whom look quite similar, where WiseTech pays a high multiple of sales for businesses that have revenue, but little if any profit or hard assets. It seems to us they're effectively paying up to buy customer relationships that they hope can be brought across the core business. These deals allow WiseTech to put what would otherwise be a cost onto their balance sheet and call it an asset. Imagine, had they employed a salesperson instead to get these customers, it would have had to gone through the P&L, and we think WiseTech would have been reporting losses. This is how they're able to grow despite spending so little on marketing. However, correct for these M&A driven customer acquisition costs, and they spend much more and achieve far less than their peers. They inflate profits even further by capitalizing close to half of their software development costs. This contrasts rather badly with their closest competitor Descartes, who, like most software companies, expenses all of their development costs. We note that WiseTech, of course, fails to mention this difference when it talks about its high R&D spend, and then compounds the misdirection by pointing investors to their rising EBITDA. Talking about EBITDA is a nonsense because it ignores the amortization costs of these capitalized developments. Software is expensive to develop, they pay cash for it, and the price of that continues to rise. It would be rather like a mining company capitalizing extraction costs and then suggesting that these are investments in the future and as such should be ignored when investors start to think about profitability. The general rule is that software companies do not capitalize development because it's a core part of their business. When you do come across software capitalization, it's usually happening at a company whose core business is completely different, i.e. construction, food or retail, possibly banking. We think WiseTech is simply bending accepted accounting practice to report profits, when in reality they lose money. Performance. WiseTech compares itself to Descartes, to Oracle, SAP, Xero, Cochlear and Altium, all of whom are highly valued, but apart from that we can't see they have anything in common with WiseTech. They're mostly in different businesses, often use different accounting and have different growth rates, margins and cash generation. We think it's far more sensible to look at WiseTech on its own merits, of which we see very few. When we look at growth, for example, we see that core revenue growth is falling. It was 38% in 18, 33% in 19, and the company itself forecasts it to be only 24% in 2020. And remember, this growth is being driven by acquisitions, which means that the deals need to get ever larger for the new customers to have an impact. The premium multiple being currently ascribed to WiseTech we think makes little sense if growth requires ever more dilution. Profitability. WiseTech looks good compared to its peers simply because of the distorted accounting. Standardize the numbers and not only does WiseTech compare badly, we think it consumes cash and loses money, as we've said before. Finally, SaaS characteristics. Adobe and the other successful SaaS companies all exhibit the following traits. First, they have operating leverage. In other words, revenue rises far faster than long-term assets because the marginal cost of providing the service is falling. And this leads to high and rising profit margins, which in turn generates excess cash even as the business scales up. In some of the cases, this excess cash is then used for buybacks, which improves capital efficiency and drives the stock price higher. They all have deferred revenue. These are the subscriptions that get paid in advance, and they usually rise in line with revenue growth. It is these traits that underpin the valuations and create such great returns for shareholders. WiseTech has none of these traits. Operating leverage continues to drop. Real margins are zero, if not negative, and it continually issues stock. Deferred revenue is also minimal. Ultimately, we think that wise technology investors should look elsewhere to try and find some real value-creating SaaS stocks. But before you go, please remember none of this should be taken as investment advice. We've sourced our facts from the company document, but the interpretation and our conclusions are just our opinion, and of course they are subjective and should not be used as the basis for an investment. If you'd like to know more about our research or want to dig into some of the issues we've covered, please visit our website and have a look at the WiseTech page using the links below. There you can download some of their recent filings where we've highlighted some of the key points. Alternatively, to keep up to date with our views, subscribe to the channel or send us an email. Thank you very much for your time.